Welcome back to the channel, guys. I just wanted to do a video around leverage and in particular leverage cover call ETFs. I feel like there's a starting point starting to appear now in the US market. It's been in the Canadian market for a while now, but I sense they're starting to appear maybe potentially in the US market as well. So I want to cover them off and just explain to people pros, the cons, what leverage actually means within the fund itself. So just to cover the core concept again of what a covered call is. A covered call is an option strategy where an investor holds a long position in an asset and then sells call options on that same asset. It's a popular strategy for generating income in the form of option premiums, but it does cap the potential upside of the underlying asset, making a trade-off between income and growth. So what happens when we introduce leverage in terms of an amplifier? So leverage in this context means using borrowed capital to increase an investment position beyond what is possible with the existing cash. A leverage cover call ETF borrows money to buy more of the underlying stocks. This allows it to sell more call options and therefore amplifying the potential income generation from the premiums. So in principle, this sounds obviously great, but what we've got to manage here is, from a standard cover call perspective, you'll have, in this particular case, we might have 90% of its stock, and then the 10% is the call option. With a leverage version, we might be borrowing, let's say 45%. We'll have 45% of stock, and then we'll have 10% of premiums. But let's look into kind of more of the deep dive of this now. Obviously, we can generate more premiums, but there's got to be a trade-off, and there always is investing. We always say there's no free lunch, so what's the catch with leverage? So when we talk about leverage in the standard sense, we look at it for every dollar that you invest in, the funds holds $1 of the asset. Okay, so this is a baseline for a standard non-leveraged ETF. And you'll sometimes see these terminologies like 1.25x, 2x, and what that actually means is the percentage of leverage above the baseline. So when we talk about 1.25x leverage, we're basically talking about 25% leverage. So every dollar you invest, the fund borrows 0.25 cents to hold $1.25 of assets. So your exposure is amplified by 25%. And then the same concept happens with 2x leverage. So you're 100% leveraged. So for every dollar you invest, the fund borrows $1 to hold $2 of assets. Your exposure is in effect doubled. So how does leverage ratios amplify exposure and risk? And from a hypothetical income perspective, if you were to look at the standard benchmark, let's say it was 8% and we had 1x, so no leverage in effect. If we then took 25% extra, so 1.25x, we would then get 10%, and then 1.5 would be 12%, 2 would be 16%, and so on and so forth. What we've got to understand is that, yes, we're getting this higher income, but what's the kind of risk-reward ratios? Now, we'll look at this from two lenses, an index leverage and a single stock leverage. So applying leverage magnifies both the gains and the losses, and this is a really important factor. But the risk profile changes dramatically depending on the underlying asset itself. So here's a kind of comparison between kind of a leverage diversified index versus a concentrated single stock. A broad index market, so you might be looking at an S&P 500 or a FTSE 100. Okay, so there's lower volatility. Diversification obviously gives you a bit more buffer against the single stock drops that you typically see, but obviously you're going to get moderate gains based on that leverage. Whereas we look at a single stock, the exposure potential returns can be substantial if that company performs well, but it's also going to be a lot more volatile. You've got that concentrated risk, and then the downside is substantially higher. So if we were to look at this from a positive news perspective, if we were to look at a leverage index, you might get 15%. With a single stock, it could go 80%. If you were to look at the average kind of year, you might get 8% in a leveraged, and a leveraged single stock might be 5%. In a negative market, this is where things get really bad. Your leveraged index might be down 12%, but your single stock leverage could be down 70%. There is a lot of trade-off there that you need to bear in mind with these leverage funds. So what happens from a performance and income perspective? So performance varies dramatically based on market conditions, as you'd expect with any cover call strategy or any real market income strategy. Now, below I've gone through again some more hypothetical scenarios of what could happen in a strong bull market, slightly bull market, sideways market, slightly down market, and a strong downward market. So in a strong bull market, let's say the S&P goes to 25%. Due to the capped nature, we would expect a non-leveraged covered call ETF to do about 10%. The leverage covered call would do about 12%. So again, extra 2%. In a slightly bull market, which is again a good scenario for these covered calls, a slightly bull one, the market does 10%, the covered call still capped at 7%. But this is where a leverage one could actually match the market or even do slightly better. Okay. In a sideways market, we would see maybe the index go up 1%, the non-leverage go up 5%, because as we know, sideways is typically where we start to outperform. And this is where a leverage could actually do a lot better at around 9%. In a slightly downward market, this is where we start to see the negative impacts of the leverage. And so the S&P, let's say, is down 10%, and non-leverage is typically seen as a hedge in a way because you're getting the income to offset that down market. So you're still taking the full downside here, but because you've got that income, it's offsetting that. And we often refer to the fact that cover calls typically have a lower beta or lower volatility than the overall market for that reason. But here, this is where the leverage can work against you. So a leverage cover call is not as good a hedge as just a standard non-leverage version. This is why, because you've got that 0.25 or the 0.5 or the 2, you could go down substantially more. And here, this is where in a slightly down market, we might drop by 15%. The worst scenario happens when we start to look at a really strong down market with leverage. And we could see, let's say, a 20% drop in the markets. Again, the non-leverage will have some level of protection at 15%, but we can see how the leverage version can go down by substantially more at 30%. So this is where you need to be a lot more careful. So we obviously need to remember that a key limitation of a standard cover call strategy is that upside capping. So it's making it very hard to outperform the underlying index in a rising market. Leverage can change that dynamic. So by amplifying the income from the options premium, a leverage ETF can generate enough cash flow to exceed the gains of the underlying asset. So this is why sometimes people like the leverage, because you're using that extra margin to do better and generate more income. So in a slightly or moderate bullish market, we can see that you can sometimes edge out on total return on an index, which is really hard to achieve without leverage. Okay. But then the potential of the outperformance is a trade-off from taking that amplified downside risk that we saw. So pros and cons there, but we can see why some people like leverage. Another kind of thing to look at this is a lot of people in the US use something called margin. You might see a lot of YouTubers talk about margin, and in a way, that's just taking leverage. Okay, that they're borrowing money from the broker and then they're buying these high yield investments in a hope that they'll return more than what the interest is they've got to pay back. So in a way, they're using leverage as a lever to generate more income. And we've actually seen the risk of that, where when the markets have dropped aggressively, they've had what's called a margin call, and brokers demanded their part of or the full amount of money back. So we can see how these things can be quite risky, but we can also see the reward potential of them. We've still got to remember that when we look at income drivers, there's obviously the theta decay and the implied volatility. So option premiums are primarily driven by these two factors, right? The time decay, the theta, and the erosion value as the option nears expiry. And then we've obviously got the implied volatility, which is the market expectation of future price swings. So obviously a higher IV means higher premium, but it also means higher risk. So again, these levers still apply to the leverage and non-leveraged versions. And what I mean by that is in a non-leveraged, if we were to have 8% theoretical return in a high IV environment, that will translate to a 12% return. And similarly, from a high IV, if we've got 15%, we could get up 25% in the leverage version. So the factors that drive the premiums in terms of the time decay and the implied volatility still apply here. Those rules are just amplified. What we've got to realize is the cost of income. So why high risk and cost matters. So chasing the highest possible yield by selling options in a high IV environment with leverage is a high risk strategy. Okay. The income percentage must always be weighed against the potential for amplified capital loss and costs. Okay, so we need to bear this in mind. So in terms of the kind of summary and risks and considerations here, from a leverage covered call, ETFs are complex instruments, okay? Understanding the inherent risks is crucial before you buy into these. The upside, you've obviously got the enhanced income. The primary benefit of that is the potential for the significant higher income generation, especially in flat markets. Many of these ETFs provide regular, often monthly cash flow to investors, but you've obviously got the amplified losses now. That leverage magnifies the losses in a declining market. The NAV can fall more rapidly than a non-leveraged equivalent. The other thing to bear in mind is rising interest rates increase borrowing costs, which can eat into those returns as well. And then obviously capped upside in a strong bull market, these ETFs will typically underperform the index, as we know. So what is the ideal investor profile for these? These are complex instruments and they're not suitable for all investors. They may be appropriate for some though. Experienced investors who fully understand the risks of leverage and options, those with a high tolerance for risk and potential volatility, and income investors who believe the market will trade sideways or in a slightly bullish range for a period of time. The key takeaways are that leverage can boost income significantly, especially in flat markets, but leverage also magnifies losses in a downturn and obviously increases risk. So these ETFs are specialized tools for experienced, risk-tolerant investors, and it should not form part of a non-core holding, in my opinion. So there you go. Again, this doesn't constitute as financial advice. Make sure you do all your homework. All investments involve risk, but I just wanted to cover off because I feel like these leverage products are likely to become the next big thing that comes out in the income investing world. We've seen them come out in Canada. I know a lot of American funds are starting to explore leverage as well. A lot of people use it in terms of margin within their brokers. And I just wanted to explain potentially why people do it, why they might invest, but also the risks that are also involved in that. All right, there you go, guys. I hope that was useful. I will catch you on the next one.